Let's focus on the oil and gas stocks now. That's the big story, the spike of 10% in Brent and WTI. Dayanand Mittal, oil and gas analyst at JM Financial, is now with us on the show. Dayanand, hard to say how this will play out, but just let's start with the sensitivity. If there is a $1 increase in crude prices, Brent, for instance, how will it impact the upstream companies, the downstream companies, and even if there is a second-order impact on account of the subsequent increase in gas prices, etc. So let's start with, putting the sensitivity on board.
Thanks, Reema. So for every $1 increase in crude, given now there is no windfall tax, so there's no cap on ONGC and Oil India's realization. So every $1 increase in crude has a positive impact of 1.5 to 2% on ONGC and Oil India's EPS. And for OMCs, on the marketing business, so every $1 increase in crude reduces their auto fuel marketing margin by 50 paisa per liter. So so when crude was around $65 to $70, they were making about 10 to 12 rupees per liter. Now, as per our calculation, at 77, 78, that has now come down to around 3.5 rupee per liter. Now, this is in line with what they've been earning historically, which is 3.5. So they were enjoying a very strong margin last few months, and now that has got normalized. Now every 50 paisa lower marketing margin has an impact of about 7 to 8% on OMC's EBITDA. So last 4Q and probably this quarter, OMC's EBITDA would have shown very strong growth. Probably this spike in crude will mean 2Q onwards, there could be downside risk to the current earning trend.
Hi, Dayanand. Good morning. Good to see you. And just to get that number out of the way, with regard to OMCs, their margins for the past quarter were how much, for the initial 2 months, because everyone's bracing for a very good set of numbers coming in there. But now, post this price spike, if I got that number correct, it's come down to around 3.5 rupees, right? Yeah. But prior to that, what was it?
Yeah, so for 4Q FY25, the quarter which was already reported, the auto fuel marketing margin was 7 rupee per liter.
Correct.
In 1Q till date, our calculation suggests it would be in the range of about 11 rupee per liter. This is before yesterday's jump in crude. Right? So this 11 rupee for roughly 2.5 months in this quarter. On spot basis, that margin has now come down to 3.5 rupee per liter.
Got it. And in your calculations, where are you at in terms of foreign average? Because even at 10, 11 rupees, I don't think you'll be factoring in that sort of a number for the year. So on an average for the year, what are you working with?
So for FY26 and 27, we were working at 4.2 only. And we were assuming LPG losses would get compensated. So if I have to adjust for LPG losses, then I was working with 4.2 plus 2, so 6.2.
Okay, all right, 6 months, got it. And with regard to the movement that you're seeing, as you said, the sensitivity analysis for both Oil India as well as ONGC could spell good times because of the move that we have seen on crude oil prices. What are you factoring in on crude oil prices for the year? And in turn, what is your current call both on ONGC as well as Oil India?
So our assumption was, we were factoring in crude price about $75, let's say 6 months back. But given the demand concerns and tariff-related uncertainty, 3 months back, we had brought it down to around $70. So $70 is what's our current Brent crude price assumption for all the coverage universe. Hence we had a positive view on ONGC All India because at CMP, both the names were discounting more like $60 to $65 net crude realization. So there was a decent 15-20% upside, and if the current crude price was sustained, there would be additional upside to our target prices.
So you continue to remain positive on both these two, while on OMCs you have a negative stance?
Yeah, so on OMCs we have a negative stance primarily on valuation ground. So they're trading 1.3, 1.4 time price to book. Historically is 1. And our key structural concern on OMCs is the huge capex which they're doing, which tends to be value destructive in long term because of the significant time and cost overrun.
All right. Then I'm sure my co-anchors have some more questions with regard to these stocks. But just from an India perspective, the dependence on Iran for oil had come down drastically. As of now, it's zilch. I mean, no dependence.
Yes, nil. Because of US sanctions. So India can't buy crude from Iran.
And most of the crude that's produced in Iran goes to China.
Yes, out of 3.4 million barrel per day which they produce, 1.4 odd is exported. 90% of this export goes to China.
Got it.
Yeah, no, absolutely. Our dependence on, completely unrelated, but Russian imports is also the last I checked, it's become very, very small, compared to very large numbers earlier. There. Sorry, you want to come in, Dayanand?
Yeah, not really. I think Russian import continues to be strong. It declined for a month in March, but then it picked up in April and May. So Russian imports is about 35 to 40% of our imports.
Yeah. No, I'm saying it had risen far higher. You're right. I mean, I checked with the oil marketing companies, I think the weekend before, and it's in that 25-30% kind of number. But of course, I mean, it's a big drop-off compared to where we were earlier. Oil marketing companies and stocks, Dayanand, what is your view? Let's just assume for a minute that this flare-up is just that, a flare-up, and then things settle down. So we had that Libyan disruption. Prices did not rise too much. There was a Saudi disruption that, of course, was significant but short-lived. So let's just assume, for the purposes of this discussion, that this is short-lived as well. Beyond this, how are OMCs stacked, and what's your view here?
So structurally, we are not so positive on OMCs. One, on valuation ground, they're trading at 20-30% above historical valuation on price to book, 1.3, 1.4. And our key structural concern there is the huge capex spree which they are in terms of setting up refining capacity, where there's a lot of terminal value concerns, and also petchem, where margins are quite at tough levels. And most of these capex tend to see significant time and cost overrun, and hence tends to be value destructive. So probably buying OMCs when they're trading sub one-time book is where we are comfortable with. Buying at 20-30% above price to book, I think the risk reward is against you.
No, absolutely, and I think that's the we got to buy it cheap, really cheap. That's the basic message, right? These kind of names.
Yeah, completely.
Yeah. And which is not the case right now.
Which is not the case right now.
Okay, and of course risks are also slightly higher. With all this which is happening, do you have coverage on some of the gas stocks, Dayanand? Any thoughts here?
Yeah, so we have a positive view on GAIL, which would be a beneficiary of high oil price. We also like Gujarat Gas, but it's more on the assumption that spot LNG prices moderate to more normalized levels in next 1 or 2 years, with a lot of LNG supply capacity coming in. CGDs, apart from Gujarat Gas, IGL, MGL, we have a negative view on structural concerns given the APM allocation cut and EV related impact on volumes. Yeah, so Petronet also, we are not very positive, primarily because of their capital misallocation concerns on petchem side.
Yeah. Okay, Dayanand, thank you very much for joining us. Really useful conversation this morning. We've got